This AgVision program is made possible through the generous support of Syngenta Seeds NK brand. The results you need, the freedom to choose. And by Farms.com. Ag news, market prices, ag careers, and farm real estate. You'll find it all at Farms.com.
Well, interest-only loans are tools that have been used fairly recently. I must express that I do have concern with this particular type of a tool for two reasons. First of all, it encourages further capitalization of agricultural land because the farmer doesn't have to pay off any of the principal and can devote his entire payment to the interest. And what happens then is that farmers compete with each other for land, and they tend to bid the land price up even further. And particularly at this time, that's very unhealthy for Canadian agriculture, where we're overcapitalized to begin with. Secondly, it introduces a different degree of risk for farmers. If you are a farmer and you can only afford to make a purchase by paying interest only, you'll never pay off the loan. And that means you guarantee that you will be facing higher interest rates in the future because our interest rates will rise. If you are only breaking even on that investment today and interest rates become more expensive in the future, you're not likely to make a profit on it in the future, and you may very well lose the asset or face financial difficulties because of the interest-only loan. So I would certainly express strong caution whenever considering the interest-only loan.
Well, we're just starting to see the front of that, Kevin. We've had pretty good years the last 10 years. Certainly energy prices are going up, and it's really, and the Canadian dollar. So that's really putting a crunch on the conventional farmers. I wouldn't be surprised if interest rates are going to start going up as well. And then when we get to land prices, I mean, how do you manage all that? Certainly leading farmers have uncovered really new and innovative way to secure financing. They're not always going, and quite often not going to the conventional way, conventional sources of providing either equity or debt capital. So they're going outside the family for investors to bring in equity, and they're looking at alternative sources for debt. Just a point on land prices. One of the things we find with leading farmers is the majority of them tend not to own their land. If they did own land, they're dispersing the land, or have been dispersing their land, because they have not been, they're not seeing land as an asset to hang on to, as a long-term valuable asset. Certainly in Saskatchewan, where I am, over the last 6 or 7 years, in real terms, land prices are slowly going down. And unless you're near a big city, that's going to be a challenge. So what we're seeing is leading farmers are looking to lease land simply because it gives them more flexibility to increase, decrease, and they're putting their equity up the value chain.
Actually, agriculture, for the most part, I think is in pretty good shape, and except for just dramatic changes in interest rate, would not be that negatively affected by it. For the most part, we're not that heavily leveraged. The big issue, obviously, if you're tracking an individual farm, is whether their rate of return on equity is exceeding their rate of return on assets. And monitoring that's important, because that basically tells you whether or not they're using debt profitably.
Well, I think that right now we have a very, very high ratio of capital per dollar earned. It's about 7 times higher in Ontario than the average of the United States, so we're very heavily invested for what we're earning from it. And our debt levels have increased about threefold compared to only a 17% increase since 1981 to 2003 for the U.S. What that means is that if interest rates do rise, and rise quickly and significantly, I think we will be very vulnerable. We have a number of farmers out there who are facing low price problems because of in part because of global competition, but also because of the appreciating Canadian exchange rate, which has appreciated about 33% in the last 2 years. This means that for a constant U.S. dollar price, the Canadian price has fallen by 33%. And that means that we're now getting lower prices, less income to pay off our debts. So any rise in interest rates will have a significant impact, and if they rise rapidly, and quite high, in other words 3–4%, we could start seeing farm failures, and that could create some significant problems for the Canadian agriculture system.